Hello and welcome to the first live preview program of the new year. My name's Harry. I'm the managing editor for LiveSquawk, and we'll be looking today at the impending December US jobs report due for release at 8:30 Eastern Time, 13:30 GMT. For those that don't know what we do, LiveSquawk is a live financial audio news platform serving up all the relevant news and data for traders and active investors. Visit the livesquawk.com platform and take a trial to see what we do and how we can help. We'll be covering today's non-farm payroll live as it's released from the Bureau of Labour Statistics at, as I said, 8:30 Eastern Time, 1:30 GMT. I'll be joined today by regular guest Jamie Dutch of PIQ, a fully customizable and free-to-access aggregation platform providing information for traders, and also by Chris Stadley, LiveSquawk contributor and the author of the new LiveSquawk Commodity Corner newsletter that will be launching in the very near future. There is a preview out there for today's WASDA and USDA report that Chris has written, and we've got together a little table and stuff like that. But that's for another time. We'll come back to that probably near the end of the program. We really want to focus on all things North America. There is Canadian data, labour data out today as well, which we'll look at. We'll put that with that in mind. Just to do the quick disclaimer, the content provided on this channel is for the informational and educational purposes only. LiveSquawk is not a licensed financial advisor, nor am I guess, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your own financial objectives, and consult a qualified financial professional before making any investment decisions. Investing in trading in financial markets can carry risks, and past performance is no indication of future results. I am not responsible for any losses, or LiveSquawk is not responsible for any losses. None of my guests are, or gains that may result from following the content on this channel. Now that's out of the way. As I said, I want to introduce my two guests, Chris and Jamie. Welcome to the show. First of the new year.
Thanks, Harry.
Thank you very much, Harry, for having me on. Great to be here.
Awesome. And yeah, we really are looking today at the non-farm payrolls and what to expect basically from that. Now I do have some graphics somewhere if they pull up. Let's see if I can work this out, because it's all being covered up at the moment. Anyway, I'll go through what we're looking for from today anyway. So yeah, the headline number, we're looking for 165,000 jobs according to the consensus. The unemployment rate is expected at 4.2%, and we're looking at average hourly earnings, the other main feature I think of this report, 0.3% on the month-over-month, 4% on the year-over-year. With varied responses from the main banks that we've seen. The likes of Citigroup are looking for 120,000, Goldman Sachs looking for 125, up to SocGen, Societe Generale, which is looking for 190,000 and a 4.2% unemployment rate. The likes of Oxford Economics and UBS also on the high end of that range as well. We've got the graphic up on the website and on our X platform as well for those who want to have a look at the ranges there. But yeah, as I said, in terms of what we're looking for from today, is just to slow down from last month, really. If I can read. Hopefully you can hear me again now. Yeah, sorry about that. I don't know what happened there. Just Jamie, what do you think at the moment we're looking for in terms of today's report? What are the important elements from the number?
Yeah, can you hear me properly? Yeah,
I
just
can.
logged in.
I think
Yep.
I've done something in mine to try and. I don't know
That's
what
good.
I did something wrong.
No, it's all good. All good. Yeah, main points apart from probably what you've just run through with the numbers, I guess. Just for some, I don't know whether you ran through the averages. So the average through 2024 was 180, and the last 4 months 150. Just for some reference, I guess. And if we get an inline print, that would be actually the lowest annual jobs gained since 2019, saving 2022 in the pandemic. For me, I guess, well, also deviations from actual prints are narrowing now. So the sort of pandemic is no longer distorting some of the predictions, is probably interesting to note. But otherwise, might be quite a dull market reaction, really, you'd think, with so much else going on, right? Obviously, with the bond markets moving, with a hawkish Fed, and of course, Trump incoming. And you just have to look at pricing for the next however many months, probably till May. But January, there's virtually nothing priced in for the FOMC, March 10 or 11 bips. May even, I think that only gets up to around 54% of chance of a move. So I think that kind of sums it up, which means we need a big deviation from consensus to get any major move. And even then, I would say, judging from the last couple of reports, or 2 or 3 reports actually, sort of dollar demand has been strong. So any sort of sell-off is very minimal, short-lived. And it kind of resumes within sort of half an hour or so by all accounts, the dollar dips. So, and then dollar buying and dollar pushes higher. So we're in that sort of frame of mind. We're in the hawkish sort of Fed frame of mind, which may be too much for some, probably too much for me, to be honest, with sort of 43 basis points priced in for the whole of the year. I think, there is some room there, but obviously, we're very, everyone's very bullish US exceptionalism and the dollar and stocks as well, of course. So I'm kind of very wary of that, to be honest. And I see the sort of arguments with Trump as well, even more two-sided than probably everybody's thinking as we get closer to the January 20th.
Well, we'll come on to the Trump
of course.
the dynamic very shortly. But Chris, in terms of, and I know you look more at the commodity sector and asset classes. From your perspective for today's number, is this simply just one of those sort of fillers for this month, and we'll have bigger and more important jobs reports to come in the months ahead?
Yeah, I do agree with everything that Jamie said on that. I think this will be traded, pretty darn quickly. And also, there's been some chatter that this report could, dictate Fed interest rate policy over the next several months. I think there is a grain of truth to that, but I think, their inflation expectations, and this kind of leads back into commodities, is a bigger concern. So, like, you mentioned bond yields. Bond yields are spiking again this morning. The 10-year is sitting at roughly 4.7%. That's the highest since April of last year. Crude oil spiking over $2 again, on Iranian sanctions and some other things. So, I don't know if you want me to dive into Trump right now, but I'll go ahead and tackle that. There's been a lot of chatter and, fears and what have you about, the tariff situation, what's going to happen when he takes office in 10 days. That's a bigger concern to me than just this one report. And obviously that's going to dictate Fed interest rate policy over the next several months. So there's a lot of moving parts to say the least. So
it may be a bit too early to grapple it in all in one go. I'll give you a bit, both of you, for your benefits, something that we've got from Goldman Sachs here. Speaking about yesterday's closure to markets, and yes, fixed income, they say, is making everyone else nervous. Not so much that the yields are going higher, but it's the speed with which yields are moving, which generally worries equity markets and gets everyone a little bit worried. And as I said, they're typically, this is from Ryan Hammond, I think, of the interest rates team. They say US equities are typically able to digest gradual increases in bond yields. However, when bond yields are rising sharply, e.g. by more than 2 standard deviations in a month, equities typically sell off 2 standard deviations, as in the other day, some 60 basis points. And it's especially true when the move is led by real yields. So there is the worry about the growth aspects now, I guess, and maybe some of that reappearance of inflationary pressures. We also heard from a number of Fed officials yesterday, and they appeared comfortable with a wait-and-see policy for the time being. So if we go on to, again, the implications for the Fed then, and their meeting, I think it's the end of this month, meeting. Then what do you two think? Jamie, I'll start with you first. What are your thoughts on this? As you said, I think you've pretty much covered it by saying that there's not a great deal to look at, but anything else to add?
Yeah, they're on the 29th, I think, so right at the end, aren't they? End of the month, ECB the day after, and Bank of Japan the week before. For the Fed, like you just said, they are, I think Powell said, the labour market is cooling in a way that, is not raising concerns for them. I think you've had a lot of speakers saying very similar. I think Daly was happy with the sort of balance of the labour market, Barkin pretty optimistic, and Waller sort of same thing as well. So for the Fed, I think as long as things, the economy, the labour market is still fairly solid, then they can still be fairly cautious in their next steps, I guess. And we're all waiting for 10 days' time, really, and some flesh on tariffs, really, is the main thing. And we've seen that from the minutes where, they've got the kind of new phase of this monetary policy that we're talking about now. But, that's wholly dependent on what happens, post, Trump 2.0, really. Not too much to add for the Fed just because they're waiting as much as we are. I guess, they signaled 2 rate cuts for this year, which was a surprise, obviously, in December. Most expected 3. But again, I go back to like this time last year, I think it was, where we expected how many? 8 cuts?
Yeah.
Something like that. Then we went down to 4. Then we went down to 1. Now we're back to 2, and it sort of went everywhere in between that. I think the last time I was on, I think we talked about what we thought would happen from September. And I said, I think there would be 2 rate cuts, and you were slightly less convinced and thought they might pause December, if I'm not I'm not wrong. Yeah. And I think, that kind of sums it up, and kind of what I was saying with their predictions and dot plot, 12 months and beyond is fairly, is not that accurate, should we say. So, I certainly, I'm fairly wary of, as I say, and are thinking the argument is more two-sided.
Absolutely. Listen, from my perspective, and we'll get Christian on this as well, it just goes to show you really that the bank estimates, and just it's like pinning a tail on the donkey when you're blindfolded. It's going to be even harder this year with the Trump administration coming in. Look, every administration brings with it complexities. I just think you get some added complexities with Trump and the added bonus of Musk as well in the mix this time around.
I would add, Harry. I think you're absolutely spot on, and generally the job market is cooling, and that remains a big story. But then this sharp move in higher sort of long dated treasury yields that will push up consumer and corporate borrowing costs. And I think, especially with the UK as well, market possibly kind of underestimating that, and the fact that it feeds through to growth and inflation by, of course, tightening financial conditions, and then the impact that will have potentially, as well as the dollar, of course. That's a 2-year trade weighted high. I did see that inflation adjusted is, I didn't realize actually, at levels comparative to 1985, and we know what happened then. So, possibly that will act as well as a brake on the economy. We'll see.
Yeah, Chris?
Sorry, it took me a second to get off of mute there. Yeah, I was just pulling the CPI numbers just to double check that. Right now, it sits at about 2.7%. And, you mentioned some of the Fed speakers over the past week or so. Basically, all of them in all these different interviews have said that, there's still a lot of work to get inflation down to 2%. So I think that will keep a cap keep interest rates elevated, quote unquote, the 2% or the 2 cuts that they might do this year. Who knows when they're going to happen, because there's already, according to the CME Fed Watch website, they're predicting, or there's a 95% probability that they're going to leave interest rates unchanged at this meeting at the end of the month. So, it'll be interesting to see how Fed policy evolves over the next several months, especially, if inflation stays elevated like it is right now, and we're seeing this again, across a lot of commodities like crude oil and et cetera. So.
Yeah, fair enough. So we kind of covered some of Trump anyway in terms of our conversations, but just the knock-on effect that the tariffs will have, and just how much harder that's going to make policy action for officials, I guess. Where do you guys see? I mean, look, emerging markets, for example. Just looking at just what the banks are saying about the knock-on effects here. They've entered a correctionary period on Thursday, and it's said to have been as a result of a month-long rout brought on by uncertainty over US policy and China's growth prospects. China is another basket case we haven't even really touched upon yet, and the difficulties they have at the moment trying to lift activity. You've got, and this is notes from banks, a strained pension system that's apparently in danger of running out of money in a decade, which is another new threat to young employed people in the country. We've touched upon the commodity situation with we've seen a rise in both base and precious metals like copper and silver over the last few days as well. There's a number of effects that we're seeing extraneously. I mean, I've got a Barclays note here that says sectoral tariffs are a powerful instrument against trade redirection with important FX spillovers to countries with high export similarities to China. And Barclays says it continues to recommend shorts in the yuan, longs in the dollar, Mexico, and shorts in euro Swiss. And we had fresh short positions in the euro sterling and position as well. So, I mean, there's so many things in the mix, so many dynamics working their way out here. It's going to be hard, not just the US central bank, I guess, but for central banks in general across the global emerging and developed markets to really sort of get a handle on where they're comfortable and where they seem neutral at the moment. Jamie, do you have any wider views on, say, how this might affect the ECB and what it? I mean, ECB's got its own issues at the moment.
ECB's got so many issues. I think just going back to the UK, though, and interesting that, for example, there's just 50 basis points of cuts priced into the UK curve. So, the terminal rate is 4.25%. Do we think that is that likely when everybody's talking about stagflation in the UK at some point? It goes back to these high rates just being passed through and tightening conditions, and then further out the curve that will hurt investment activity through lending rates, and then you see lower growth and inflation. I get the sort of doom loop sort of thing that is going on with yields and high yields, but I kind of, we're not there yet for me. And for tariffs and Trump, obviously that's the big top risk before or ahead of fiscal sustainability, which is again linked to higher yields probably. But tariffs. If the average on China is 20%, if there are tariffs on autos in the Eurozone, is there going to be much more than that? Obviously, universal tariffs, I think, adds about 1% to inflation. But otherwise, if you get that sort of base case, average of 20%, and on autos, as I said, that is kind of 0.3 to 0.4% onto inflation. That's not massive, and for me, then that sort of gives you a much more, as I say, a sort of two-sided argument that I think people are ignoring now as we get closer to inauguration, should we say? And I think even if you look at sort of what happened in Trump 1.0, really is where the Fed took the side of they ignored kind of inflation and they really prioritized risk to growth to the labor market from tighter financial conditions, which is kind of what I've been saying. So, it's a one-time price increase. We've got to remember that. And I think, sure, there are obviously obvious differences between now and then. But for me, further out, I guess the fiscal sustainability argument is also pretty strong regarding tax cuts because, we're in a much different position again. The US is with a fiscal deficit of 5% of GDP, debt to GDP ratio near all-time highs, and interest rates sort of double what they were in his first administration. So, that is not a sort of good sort of grounding for a lot of tax cuts beyond, say, the 0.2%, which is probably what we'll get, which is an extension of what we see already.
Yeah, I mean, I've got a piece here. This is from ING, and just before we sort of wrap this all up and look at the bigger picture, back to the non-farm data today, they talk about a mixed picture with the tariffs and the expectations, with markets barely pricing in 2 cuts. It says, nonetheless, we think the bark will be worse than the bite from tariffs as deals are struck, and we continue to see a cooling in the jobs market. Moreover, while the Fed has cut rates 100 basis points, mortgage rates have soared, consumer borrowing costs elsewhere remain elevated, and the dollar has strengthened more than 8%. All of these are counteracting the Fed's rate cuts, and we take the view that the Fed may need to push harder and cut rates further than currently discounted. Again, key data points they say to look for are the consumer price inflation and retail sales. So from their perspective, I think they back up some of what you say, really. They say President-elect Trump's policy mix of low taxation and light touch regulation is thought to be supportive for growth in the near term, while his focus on immigration controls and trade protectionism are likely to raise inflation pressures over the medium to longer term. So this plays out over time. This isn't a wham-bam thing from their perspective, at least. And again, we bring it back round to today's jobs report. I guess the reaction function from markets back off yesterday's enforced break is going to be interesting to see as we're starting a new year, new positions, new books, and it's going to be just to see us to stay sustained. An out-of-line number is going to be, as I said, the consensus is for 165,000. I've got just an interesting one here from Goldman Sachs again, and they're looking at reaction function at the headline print in a vacuum. For example, if nothing else happens, and we look at this number today, they say anything over 200,000, S&P sells off at least 100 basis points. 175 to 200,000, S&P sells off 50 to 100, 150 to 175, and the S&P plus or minus 50 basis points. If we go down to 125 to 150, they see a rally between 0 and 50 basis points, and 100,000 to 125, they're looking for a rally of the S&P of 50 to 100 basis points. And then below 100,000, they just see a sell-off between 0 to 50. And again, this is from a bank, Goldman Sachs today, that's looking for 125,000 for December. They say big data indicators indicated a sequentially softer pace of job creation, and we estimate that an unfavorable calendar configuration could weigh on job growth by some 50,000. So, there's all to play for today. I think in terms of just a short-term reaction, Chris, like you said, this is one of those days you get a free hit, I guess, in terms of trading whatever it is, be the commodities or the financial futures, because really you don't see a sustained move in any direction unless there's something really adverse in today's report.
Yep. Just like Jamie said, at the outset, I think this one will get disseminated quite quickly, and then we've got to move on to the other issues that we already discussed. So, if I can just bring in one last thing about
sure.
the Trump tariffs, if I could, I'll cut this as quickly as I can. First of all, these are obviously campaign trail things that he said. So, he would not be the first politician to make campaign promises and then, something else happens, completely differently once he gets in office. So just something that we got to remember. And these could be just bargaining chips as well. So, who knows if any of this stuff is going to come to fruition, and or likewise, if he's said that, we're going to put X tariff on X country, it might end up being half of that or a third of that. So, there's a lot of wild cards out there. So,
yeah, very much. That's a good way to end it, really.
The art of the deal.
It's the art. Yeah, exactly right. And we've still got to see that play out, really, and just how stubborn some of his adversaries want to be with him. Look, he's got this is his last term in government. He can go all hell for leather with this. But he doesn't want to be responsible. He wants a legacy. I've said this before as well. I think he wants a legacy where he's seen as one of those presidents that got stuff done. And it'll be interesting to see how he goes about bringing about that legacy over the next 4 years. Just to go back then, and just to quickly, I want to quickly just go over the numbers for today, in case anyone missed it at the start, because I pressed the wrong button. But so non-farm payroll seen 165,000 from 227,000 last week. Private payroll seen at 140,000 versus 194. Manufacturing expected to add 5,000 jobs after 22,000 gain in November. Average hourly earnings seen up 0.3. That's a tenth below last month. Year over year, 4% would leave it on hold, unchanged from last month. And then we're looking at weekly hours, all employees, 34.3 from 34.3. As I said, the unemployment rate seen expected at 4.2%, with participation rate at 62.5%, unchanged as well. We do have Canadian data, and with everything, we haven't touched on Canada and the political, I wouldn't call it turmoil as such. This was coming in a long way off, but President Trudeau's stepping down and everything that's now ensues from that. We can probably do that in another program on its own. But we do have Canadian Labour data out. We're looking for a gain of 25,000 after 15,500 job gains last month. Unemployment rate seen at 6.9% in December, up from 6.8%. And we're looking at hourly wage rate for permanent employees, 3.8%, which will take it a tick down from 3.9% last time round. So a lot of information, again, a lot of stuff to churn through. But ultimately, I guess what you two as guests are saying is that treat it for what it is on the day, because there's a whole heap of stuff coming down the line over the next few weeks to really take us in any particular direction. So it's I think a busy start to the year, which is what we want. We want a bit of volatility, want a bit of movement out the markets, to give those intraday traders a bit more of an edge, and bring it on, I guess. Guys, thank you very much for taking part. It's always good to have your input, and we'll have you on again over the course of the year.
Thanks, Harry.
Thank you, Harry. All the best.
Brilliant. Yeah. Thank you very much. And just a final reminder, try out LiveSquawk.com. You can go to the website and take out a trial. For those that want up to the second aggregated financial news, we're the place to be. Trial a week-long trial, and just see if it suits your needs. But thank you for listening. This will be up on the social media platforms for you to take in ahead of the number. The number is out in we got 45 minutes before the data release there as well. And keep an eye out, as I said, for LiveSquawk's Commodity Corner, a focused look at all things commodity related, with weekly newsletters out for that from Chris Studley as well. So thank you again, and happy New Year and happy trading.